Let's jump right in. Today, we're unpacking a really fascinating case study in corporate growth. Now, I want you to put yourself in the shoes of a Wall Street analyst for a second. Think about it. What does an investor actually do when a company doubles its revenue? Do they just, pop the champagne and buy the stock? No way. A seasoned investor immediately grabs their magnifying glass to read between the lines because they absolutely have to find the true engine driving the business. So today, we're looking under the hood of PNGS Reva Diamonds and their Q1 FY27 results to see exactly why investors monitor these specific types of earnings reports so closely.
Okay, let's dive into this. Here's our structured roadmap for analyzing this report exactly how a pro would. We'll hit the blockbuster Q1 headline numbers, unpack that margin expansion, look at some strategic shifts in retail, read the fine print, and wrap it all up with the long-term investor view.
First up, those blockbuster Q1 headline numbers. Now, before we strip away all the layers, we really have to marvel at the sheer magnitude of the growth streak this company is currently on. I posed this question just a minute ago, and it's the perfect investor lens for us to use. When casual observers see a company double its revenue, they just cheer at the big numbers, right? But pros immediately ask how the mechanics work. Is this growth organic? Is it sustainable? Did they just slash prices to move inventory, or is this actually high-quality growth? Let's take a look at the first major data point that had analysts sitting straight up in their chairs. 119.5%. That is their year-over-year revenue growth, bringing revenue from operations to an impressive 118 crore rupees for the quarter. What makes this number truly stand out to an investor is that management noted this is their second consecutive quarter of delivering over 100% year-on-year revenue growth. So they aren't just having a lucky month here, this is a sustained streak of massive top-line acceleration. But then you look a little further down the income statement and you hit this number, 265%. This represents their profit after tax, or PAT, growth. It jumped to 27.21 crore rupees. And right here, this is where the investor's ear really perks up. The top line, the revenue, grew by roughly 120%. But the bottom line, the actual take-home profit, grew by 265%. It sets up a beautiful mystery. Why, and more importantly, how, did profit grow so much faster than revenue? Let's move to Section 2, unpacking the margin expansion. Now, what's really interesting about this cascading growth effect is how it points us straight to the engine driving these numbers. Look at the acceleration at each level of profitability. Revenue grows at 119.5%. But then EBITDA, earnings before interest, taxes, depreciation, and amortization, that grows at a massive 192.88%. And finally, the profit after tax balloons by 265%. This is the exact progression an investor monitors to confirm that a business is scaling efficiently rather than just buying revenue with heavy marketing or crazy discounting. The financial term for this phenomenon? Operating leverage. It's a core metric for growth investors. Basically, it happens when economic scale allows your revenue to grow significantly faster than your fixed costs. So all that extra revenue just flows straight down to the bottom line, resulting in an outsized expansion of your profit margins. And we don't even have to guess if this is what happened, because management explicitly cited that economic scale played a great part as revenue nearly doubled, pushing their EBITDA margin up to a very healthy 28.76%. But, it wasn't just accounting magic. There are real-world mechanics driving this. Investors monitor the underlying product mix to see if the growth is durable. Here, volume wasn't the only driver, though diamond caratage volume was up more than 50%. Management noted better price realization on that caratage. Plus, there's this massive strategic shift happening across their network. Customers are actually moving away from lower-margin plain gold jewelry and shifting toward higher-margin certified natural diamonds. And Reva is delivering superior quality, specifically VVS EFF FG diamonds, which they note is above industry norms. Higher volume, better pricing, and a richer product mix, that is the exact recipe for the operating leverage we just saw. Moving right along to Section 3, strategic shifts in retail. So the product is selling, margins are expanding, but a smart investor always wants to know where these sales are actually happening out in the physical world. This massive growth isn't just concentrated in their home base of Pune. Management noted that demand uplift is broad-based across 21 different cities. Currently, their footprint consists of 34 SIS, which stands for shop-in-shop locations, and 3 COCO, or company-owned, company-operated stores. They are successfully proving that their luxury brand resonates across a really wide, geographically diverse customer base. And this brilliantly illustrates a massive strategic shift currently underway at the company. Right now, about 90% of their revenue dependence is on those shop-in-shop locations within P and Gadgil and Sons. But their future target over the next 2 to 3 years, they want to reduce that dependence to just 20 to 25%. How? By aggressively scaling up their own exclusive brand outlets, focusing heavily on Tier 1 cities and selectively expanding into Tier 2 and metro cities. Investors monitor this like a hawk because transitioning from a shop-in-shop model to operating your own exclusive stores requires serious capital and operational execution, but it also offers absolute control over the brand and the customer experience.
Section 4. Reading the fine print.
Now for the turning point of this explainer. We've seen the incredible growth and the ambitious plans, but a savvy investor never, ever takes the highlight reel at face value. Check out this surprising twist that completely changes how we view those blockbuster numbers. Despite reporting over 100% growth and massive profit margins, historically, Q1 is actually their weakest season of the entire year. Management reiterated that Q1 typically accounts for only about 15% of their annual turnover. The second half of the year, especially Q3 and Q4 during the festive and wedding seasons, makes up roughly 65% of their sales. So to put that into perspective, if they are pulling in 118 crore rupees in their quietest quarter, the baseline expectations for the second half of the year are going to be astronomical.
But here is exactly why investors read earnings call transcripts line by line. Hidden right there in the commentary was this critical quote. Management noted that their Q1 marketing spend remained relatively modest, intentionally planned to be deployed over the upcoming quarters rather than upfront. Because of this delayed spend, they explicitly flagged a 200 to 300 basis point margin headwind coming in the next quarters. So, those incredible 28% EBITDA margins we celebrated earlier, yeah, they were artificially inflated because the company basically just delayed its marketing bills. An amateur investor buys the stock expecting 28% margins forever. A pro? A pro reads the transcript, adjusts their model down by 300 basis points for Q2, and completely avoids getting blindsided.
Finally, Section 5, the long-term investor view.
Let's synthesize everything we've learned, the trailing financial metrics with the forward-looking risks, to establish a truly holistic perspective on this company. Despite the incredible Q1 performance, management demonstrated remarkable discipline here by refusing to formally revise their guidance upward. They explicitly cited a philosophy to underpromise and overperform. I love that. They also acknowledged the execution risk in their store rollout, stressing a slow and steady approach that prioritizes profitability and payback over simply boosting their store count numbers. Investors highly respect this kind of disciplined capital allocation. It shows a management team focused on sustainable value creation rather than just chasing quarterly hype.
Furthermore, the structural industry tailwinds supporting the business are incredibly strong right now. Management pointed out that a recent correction in gold prices is expected to heavily support jewelry purchases heading into the wedding and festive seasons. There's also this massive macro-level shift happening where consumers are moving away from unorganized jewelers and migrating toward trusted, organized, branded jewelry. Couple that with the sustained demand for certified natural diamonds, and you have a macro environment that remains highly favorable, even with those upcoming margin headwinds we discussed.
So, what does this all mean? We'll leave you with this final, provocative thought to ponder. Now that you've applied the true investor lens to this business, ask yourself, can PNGS Reva maintain its 100% plus growth streak as it executes a highly complex transition away from its low-cost chop-and-shop model to building out its own exclusive brand outlets? The macro tailwinds are absolutely at their back, and the product is clearly resonating, but the execution risk in the coming years will be the true test of this management team. Keep a very close eye on those Q2 margins, and we will see you on the next explainer.